Joining us is Anil Gupta, the VP of Financial Sector Ratings at ICRA. Anil, good having you. Thanks much for joining in. What's the base assumption for these upgrades, that the GNPAs will come down and the overall sector is improving? Why is it that you've given this upgrade in the first place?
Yeah, thank you, Neeraj, for inviting me on the show. If we look at our estimates, first of all, I'll talk about the ratings. We have revised the rating on 4 public sector banks from negative to stable. But even after having changed the outlook on 4 banks from negative to stable, we still continue to have 8 out of 21 public sector banks on negative outlook. So it's not about a simple paintbrush, like we are just equating all banks after the massive capital infusion which the government has done in 2 banks, because still we believe that public sector banks, not all of them will be in a position to make profits, though the overall sector will be profitable. So as per our estimates, depending on how the asset quality and the credit provisioning pans out, we expect that in a stress case scenario, 10 banks can continue to make losses even in financial year 20, as against almost around 16 banks which are expected to make losses in financial year 19. So it's not in general bullishness, but if you look at the trajectory of the profitability from a loss of almost a 70,000 crores loss which the banks are going to report in financial year 19, the profitability estimate across all the 21 public sector banks is estimated at around 30 to 35,000 crores for the next financial year, and it is very minuscule in relation to the net worth of these banks. So the net worth of these banks is upwards of 6 lakh crores, and in relation to that, a 30,000 crore of profit translates into a mere return on equity of around 4 to 5%. So it's not a very significant turnaround in their profitabilities. But if we look at in absolute terms, after 4 consecutive years of losses, they will return back to the path of profitability. For the last 4 years, from financial year 16 to financial year 19, the banks have been reporting, public sector banks have been reporting losses. And coming back to the rating action, 4 banks where we have taken a rating action, these are banks which have also exited PCA. 4 banks, 3 banks out of the 4 banks, like Bank of Maharashtra, Bank of India, Oriental Bank of Commerce, are the 3 banks out of 4 where we have revised the outlook to from negative to stable. And Punjab National Bank, where we had a negative outlook, again there we have revised the outlook to stable, primarily because the threat of the capital breaches which were there for this bank is now mitigated after the sizable capital infusion which Government of India has done in this bank. On the other 2 banks, where we have not only taken a action in terms of revising the outlooks from negative to stable. In fact, one of the banks we have also revised our outlook to negative, which is Bank Bank, largely because if you look at the losses which the bank has done and the slippages which the bank has made in the 9 months. So the capital allocation to this bank has not been commensurate to the quantum of slippages as well as the loss which this bank has done and expected to make in financial year 19. So in this case, because the commensurate to a rating level, the capital cushion have weakened. So this will remain above the rating regulatory capital requirements, but the capital cushions have weakened after the losses and no capital infusion which this bank has done.
Okay. For IDBI Bank, even after LIC coming in, will there still be pressure due to credit provisioning? Just wondering what's the call that you've taken here?
So apart from the Government of India, which infused sizable capital, LIC has also infused sizable capital into IDBI Bank of around 21,000 crores. But as per our estimates, because of the high level of NPAs, the large portion of the capital will go into the loss provisioning on these NPAs, because recovery has not been to the extent the way it was expected from these NPA accounts. In fact, as per our estimate, though the bank will not breach the regulatory capital ratios next year because of the large capital infusion, but in case of the ability to reduce its net NPA come out of the PCA framework, that will remain a challenge for the bank, because even after the sizable capital infusion, the net NPAs continue to remain in double digits. And as per our estimate, if the bank has to really come out of the PCA, they will require around 5 to 6,000 crores of capital, for which they have an option of divesting their non-core assets and as well as raising fresh capital from the markets. So pending that capital raise, because now Today, RBI has also classified this bank as a private bank. So we really need to see the way the bank is able to raise this capital, because capital is sizable in relation to its size and requirement and the profitability or the outlook on profitability which is there on this bank.
Is the rating action for Bank of India, OBC or Bank of Maharashtra driven by the fact that they are now out of the PCA framework, and therefore there could be a pickup in credit growth for these banks and hence a structural change for all of them?
Yeah, yes, you are right. So one is basically they are coming out of the PCA, but also we should see the solvency, which is the net NPA or unprovided NPAs against the net worth of these banks. So after the government has infused the sizable capital, these banks have been able to provide heavily onto their NPAs and reduce their net NPAs below a 6% level, which has supported their exit from PCA also. So as a bank, their solvency ratios, unprovided losses have been recognized upfront. They have been accelerated because the capital infusion was sizable, and now these banks can stop worrying in terms of the PCA inclusion, and now go back to the path of growing their loan books. Possibly they will exercise due control in terms of going back to maybe concentrated or large exposures, and those things we need to see. But again, when we look at these banks, these rating of some of these banks remain at the lowest level. From the lowest level of the rating, their outlooks have been revised from negative to stable. So even after a stable outlook, they continue to remain rated at one of the lowest levels among the various public sector banks. And the future trajectory will be dependent on how they do in terms of their future asset creations, like what sort of loans they give, quality of those loans, and so as per our estimate, these banks, despite exiting the PCA, they will still require growth capital next year and the regulatory capital also. So they will not breach the capital ratios as such, but if they have to grow, they need fresh capital next year. So despite a stable outlook, the ratings are at a much lower level, I would say.
Again, one of the theses that I think I read in one of the notes that you guys shared was that the PSU bank deposit share is going to rise and private banks will slow down.
Yeah, so I think after last 2 years, it has been an easy run for the private banks, at least on the asset side. So they have been able to, because these public sector banks were out of competition. So definitely they have been able to garner the market share on the asset side. But in the process, what has happened is their dependence on the bulk deposits, because your core deposit has a natural pace of growth. So your franchisee gets developed overnight. You have to really work hard over the years to develop your retail franchise. And the deposits you can accelerate by mobilizing bulk deposits, typically, which can also come at a higher cost in a tight liquidity scenario. Now, when these private banks, when the public sector banks were out of growth, in a growth mode, they were not there for last 2-3 years. The competition for deposit was also relatively limited because these banks were not chasing the deposits. So what we expect is now there will be heightened competition from the public sector banks also, because they will also now get into the lending space. So they will also need to mobilize some amount of deposits, and the competition will go up. In terms of really denting on the core depositor base of the public sector banks by private sector banks, yes, there have been some cases where the banks have been able to offer, they have been offering higher rates on their savings as well as their term deposits. To some extent, there has been a migration of the retail deposit, but it's not very significant. So retail depositor base continues to remain good. If you look at some of the public sector banks, their YOY deposit growth in their saving accounts itself is upwards of 10%. So it's not a cakewalk for, I'll say, the private banks to get dent into the deposit franchise of the public sector banks, and that remains a unique advantage for the public sector banks, not only in terms of the availability of the funds, but also in terms of cost of funds. So cost of funds also, the private banks the public sector banks continue to remain much better because of their relatively, you can say, higher share of retail deposits, which tends to be sticky and not very rate sensitive if in a shorter term. In a longer term, yes, rate difference can really make a difference in terms of moving the customer base. So we have to see this, how it pans out maybe over next 1 or 2 years, because there will be a heightened competition, and we possibly the cost of funds, cost of deposits, we think it should go up. And in terms of lending rate, it is difficult to reduce your lending rates when your deposits don't go down.
Okay, Anil, we'll leave it at that. Thank you so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time.